Hello? Yes. Good morning, everyone. Great. Dear members of the Boston Economic Club, the Federal Reserve Bank of Boston, and those attending through video access, welcome to all of you. Today, we are honored to have President Susan Collins to be our speaker in a joint meeting with the Boston Economic Club and the Federal Reserve of the Bank of Boston. The Boston Economic Club extends deep gratitude to the Federal Reserve Bank of Boston for its assistance in making this event happen. You know who you were who helped on this. Thank you. President Collins will begin with prepared remarks. Her presentation will be followed by a conversation with Dr. Juhi Dhawan, Managing Director and Global Macro Analyst of Wellington Management. The meeting will end with an open Q&A session. Due to the number of participants and the limited time, we kindly ask that all the questions be kept short and without extended preamble. Dr. Collins is President and CEO of the Federal Reserve Bank of Boston, part of the U.S. Central Bank. She is a participant on the Federal Open Market Committee, which sets the U.S. monetary policy. She oversees all the bank's activities, including economic research and analysis, banking supervision, and financial stability efforts, community economic development activities, and a wide range of payments, technology, and finance initiatives. She is a widely published international macroeconomist with a lifelong interest in policy and its impact on living standards. She has served as a provost, dean, professor, research scholar, and board member of a variety of universities and organizations, including the University of Michigan, the Brookings Institute, Georgetown, and Harvard universities. She earned her doctorate in economics from the Massachusetts Institute of Technology and her undergraduate degree from Harvard. Please welcome President Collins. President Collins.
Greg, thank you very much for that kind introduction. And good morning. It is wonderful to see all of you here this morning. And I have to say, it's just a real pleasure to welcome back the Boston Economic Club members today. We are, really delighted to host you and appreciate the relationship that we have had with the Economic Club for some time and the role that it plays in the vibrant economic financial ecosystem of Greater Boston. So thank you. I look forward to sharing my thoughts about economic conditions, and that will be most of my remarks this morning. First, as always, my standard disclaimer. My comments are my own and not necessarily those of colleagues at the Board of Governors or at the other reserve banks. But before I turn to the economy, I would just like to start with a few opening observations. So it's become a tradition for the club to invite Fed staff to attend when Boston presidents speak. And so today, in addition to club members, the audience includes many employees of our bank. And so in the context of all of the recent discussions about the Fed's roles, about independence from political pressures and opportunities to be more effective and more efficient, I just want to say a few words about our people. At his final press conference, outgoing Fed Chair Jay Powell said that this institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. Earlier this year, he also said, "I'll tell the next chair that you are about to meet the most qualified group of people you not only have ever worked with, but you will ever work with. There isn't a better cadre of professionals more dedicated to public well-being than those who work at the Fed." And having been at the Boston Fed myself for almost 4 years and seeing it in action, I wholeheartedly agree with those sentiments. Many people really don't realize the breadth of the work that the Fed does. And that's not because of so-called mission creep. It's because the central bank plays vital roles in a wide range of activities that underpin healthy functioning of the U.S. economy and financial system. Fed staff here today include economic researchers who support our role in making monetary policy by analyzing domestic and global economic and financial conditions. Staff involved in supervising some of the region's financial institutions to ensure safety, soundness, and fair access to credit, as well as access to central bank liquidity. Staff working to support payment services and platforms that safely and securely move trillions of dollars every day. Staff who build and support the IT infrastructure and platforms allowing all of those functions to operate. Staff focused on ensuring the Fed engages, hears from, and is responsive to the public that we serve. Staff who perform also the essential corporate functions from human resources to finance, all of which enables our work. These people support our congressional mandates, a resilient financial system, and also our pursuit of a vibrant economy that works for everyone. We're steadfast in our commitment to serving the American people, and we'll continue honing and improving how we do that. In fact, over its history, the Fed has continuously evolved to meet new opportunities and new challenges while seeking greater effectiveness and efficiencies. And we've always adapted and modernized and embraced innovation, whether that's updating our payments infrastructure or upgrading supervisory approaches or streamlining operations to be even better stewards of public resources. So now let me turn to the economy, and there's a lot to talk about. I want to share my assessment of current conditions, my outlook, and then the implications for policy. So a lot has happened since I last spoke to the Economic Club just a couple of years ago. In particular, the Middle East conflict has increased economic uncertainty, and a lot depends on when and how the hostilities are resolved. But other factors are also contributing to heightened uncertainty. These include the extent and timing of productivity gains from adoption of new technologies, as well as the ultimate impact of other supply-side developments, such as tariffs and immigration changes. So starting with current economic conditions, and there we go. So starting with current economic conditions, the left panel of Figure 1 shows real GDP, which grew 2% at an annual rate in the first quarter of 2026, after growing at a similar pace last year. Despite a series of still unfolding supply shocks, including tariffs in 2025 and the oil shock more recently, economic growth has remained resilient. And while the labor market has clearly softened from the overheated conditions of 2023 and 2024, the unemployment rate, which is shown in the right panel, is still low by historical standards. At 4.3% through April, it's also been relatively stable since mid-2025, despite slow hiring. And I'll have more to say in a moment about this rather unusual balance in the labor market. Turning to the price stability side, there we go. Okay, turning to the price stability side of the Federal Reserve's congressional mandate, Figure 2's left panel shows personal consumption expenditures, or PCE, inflation. That's the metric that the Federal Open Market Committee, FOMC, targets at 2%. So while it's way down from its 2023 peak, inflation's been above target for over 5 years, and it's increased recently due to the jump in energy prices largely. I'll also highlight that the post-pandemic period of high rates of inflation has resulted in a surge in the level of prices, and that's shown on the right-hand panel. As I travel around New England, concerns about high prices are, I'll just call them ubiquitous, especially for lower and middle-income households, but more generally. And that's been exacerbated by higher energy prices. And so in this context in particular, I believe it's all the more important to durably return inflation to the FOMC's 2% target in a timely way. So one important factor shaping the outlook is the conflict in the Middle East. And even if efforts to resolve hostilities and reopen the Strait of Hormuz succeed relatively soon, it'll likely take some time to rebuild infrastructure and replenish inventories. So supply disruptions could persist and possibly induce lasting changes to some global linkages. To assess the impact of higher energy prices on inflation and economic activity, it's instructive to consider U.S. oil dependence. The left panel of Figure 3 highlights that the U.S. economy's oil intensity, and that's measured here by barrels of oil consumed per $1,000 of real GDP, oil intensity has declined significantly. And the right panel shows that the amount of net U.S. imports of oil and petroleum products measured on the same basis has also declined over the past 2 decades. In fact, the U.S. has recently become a net energy exporter. These structural changes have important implications for how the current energy shock is likely to transmit through the U.S. economy. First, lower oil intensity implies that a given oil price rise will have less adverse effects on inflation, real activity, and employment. And second, becoming a net energy exporter should result in even smaller negative effects on real activity and employment, because higher oil prices boost revenues of domestic oil producers, which in turn stimulates demand. And at the same time, this positive demand effect could add to the inflationary pressures. Given these changes, the positive correlation between oil shocks and future consumer price inflation, while still present, is now smaller than it was in the 1990s. And this is especially true for core inflation, which excludes the volatile food and energy prices. In other words, the second round effects of an oil shock on non-energy prices are now less pronounced than they were in the 1970s and 1980s. And the negative correlation between oil shocks and future employment growth that prevailed before the mid-1990s has weakened significantly. So, of course, these simple correlations should be interpreted with caution, but they suggest that the current oil shock will likely have a modest impact on the domestic economy overall, and perhaps somewhat more adverse effects on inflation than on the labor market. This relatively benign assessment is not without substantial downside risks. A prolonged conflict would put even more pressure on an already strained global oil supplies. The current supply contraction is quite large by historical standards, although so far the shortage has been partly offset by countries running down their inventories. But if shipments through the Strait do not resume soon, global economic strains, which are already high, especially in Asia, will intensify. And this would increase knock-on effects on global supply chains and exacerbate inflationary pressures, as well as adverse effects on the domestic economy. As shown by the blue line here in Figure 4, there are already signs of delivery time increases for U.S. trading partners. These typically do lead to increases in domestic delivery times, and that's shown by the yellow line. And longer domestic delays are often associated with a subsequent rise in U.S. producer prices. So in sum, the ultimate economic impact of the oil shock remains to be seen. Even though the U.S. economy is relatively insulated, the longer the conflict persists, the greater the likelihood of more substantial negative spillovers. I see the U.S. outlook as also depending on whether offsets could lessen the energy shock's impact on real activity. This seems to have happened last year with the tariff shock that so far has had less impact on activity than most forecasters expected. If firms continue to invest and households continue to draw on their financial wealth to help finance spending, the pace of economic activity should remain solid. And in this respect, underlying economic fundamentals remain healthy overall, despite some pockets of stress. Firms' cash holdings are elevated, and households' financial asset holdings remain high. So the dynamics that supported the economy in 2025 could continue. The extent to which this happens, though, will partly depend on the persistence of recent productivity gains. And as shown in Figure 5, output per hour, or labor productivity, has accelerated notably since 2019. The current average productivity growth, which is about 2.5%, that's shown by the yellow dashed line, is about double the average growth in the decade and a half before the pandemic, which is shown in the blue dashed line. Faster growth is not only from AI adoption, but it also reflects firms' broader efficiency gains, and those were driven in part by necessity. Facing hiring challenges when the labor market was especially tight after the pandemic, many firms found ways to boost the productivity of their existing workers. So far, large productivity gains have contributed to historically high firm profitability, which in turn has significantly boosted capital spending, especially on high-tech equipment and data centers. Strong profits and the promise of new AI-related technologies and future productivity gains have also led to high equity valuations. And together with elevated housing prices, this has increased household net worth relative to disposable income. And as shown in Figure 6, this is very high by historical standards. So not shown here, but I do want to note that net worth for the bottom 40% of the income distribution is also elevated. However, those holdings are small overall, certainly a lot smaller than the scale shown here. And in conversations throughout New England, I frequently hear about lower income households facing financial strain, and that strain has been exacerbated by the high energy prices. So although productivity growth is notoriously difficult to forecast, I see the current healthy pace as likely to persist over the medium term as technology-related investments continue and AI is increasingly adopted. But it may take some time for these investments to be more fully reflected in expanded productivity capacity. And in the meantime, the positive demand effects already at work could persist with implications for inflation. Productivity dynamics also have important implications for the labor market and are likely a key reason for the, key reason for the unusual balance that I mentioned earlier. The blue line in Figure 7 shows the, sorry about that. The blue line here in Figure 7 shows the unemployment rate, which I showed earlier, but this is focusing on the recent period, and it highlights the relative stability in recent years. At the same time, job growth, which is shown here on a 12-month average basis by the yellow line, has clearly been slow. Hiring averaged only about 22,000 jobs a month since last July, and last July is when unemployment rate was also at 4.3%, which is the same level as now. This situation of low job creation but a stable unemployment rate largely reflects a slowdown in labor demand and a commensurate decline in labor supply growth that's linked to the significant reduction in immigration. Other indicators are also consistent with a labor market imbalance. In particular, labor force participation among the prime age population, those aged 25 to 54, is holding up well. And that's shown by the blue line in Figure 8, while total labor force participation, which includes people older than 16, which is the yellow line, is trending lower. That largely reflects population aging. In fact, after accounting for this aging effect, the overall participation rate remains healthy, suggesting that workers are not becoming discouraged and leaving the labor force at a particularly high rate. But a key question is how productivity improvements will affect the demand for workers going forward. And in this respect, it's worth noting the rise in the unemployment rate for college graduates and the associated rise in the duration of their unemployment spells. This is especially the case for those aged 25 to 34, which is the green line in Figure 9. And it suggests that more educated workers early in their careers are having a particularly difficult time finding jobs, which is an atypical pattern that could reflect a shift in employers' desired skill mix. At the moment, the potential skill mismatches due to ongoing technological change seem manageable overall, though the additional time it takes to find a job can put significant strain on individuals and their families, and there's a risk that job-finding challenges could become more widespread. and a weakening of labor market conditions could offset some of the positive demand effects from higher productivity growth that I mentioned earlier. So, what does all this imply for the inflation outlook? The blue line in the left panel of Figure 10 shows the same 12-month PCE inflation measure that I discussed earlier, with the most recent data point highlighting the March increase in energy prices. The yellow line depicts core PCE inflation, which, as I mentioned, excludes the important but volatile food and energy categories. It provides one indicator of underlying inflation. Core inflation has also remained above 2% for more than 5 years, with no progress since 2024. The longer and more disruptive the conflict in the Middle East is, the larger the inflationary impact, and not just on energy, but also on food and on many categories of goods and services that are in the core basket. And I do want to emphasize that continued high inflation does not appear to be driven by labor market pressures. The red line in the right panel of Figure 10 shows that wage growth adjusted for productivity has returned to the range that before the pandemic was consistent with 2% inflation. At the same time, core PCE inflation, and that's shown again by the yellow line, just for comparison, remains elevated. Above target inflation is partly due to tariff effects, and that is especially true for prices of goods. The left panel of Figure 11 provides two measures of core goods inflation, which excludes energy goods. The blue line is data averaged over a 12-month window, while the yellow line shows annualized 3-month core goods inflation. That gives a recent, so it's a more recent picture, but clearly it's also quite a bit more volatile, and the monthly data is more volatile still. The data show that core goods inflation rose notably in recent months after returning to its pre-pandemic range in 2024. However, my staff estimates that much of the pass-through of tariffs into total inflation, perhaps about 70%, has already taken place. This is illustrated by the blue line in the right panel, and the shaded band shows the uncertainty around these estimates. The estimates indicate that tariff pass-through to consumer prices has also stabilized recently, suggesting that tariff effects on inflation should wane going forward. But in the near term, we could see some additional tariff-related price increases, in particular if tariff rates revert to levels that prevailed before the Supreme Court ruling. The other two components of inflation are less impacted by tariffs, and they're shown here in Figure 12. Housing or shelter price inflation is in the left-hand panel, and that's come down from its surge, and it's back in its pre-pandemic range. However, services inflation, if you exclude housing prices, which is shown in the right panel, that remains elevated above levels that are consistent with 2% inflation. And I will say that I find this pattern particularly notable because a considerable portion of the labor productivity improvements that I talked about earlier have accrued to the services sector. And to me, this suggests that with relatively solid demand, firms are retaining or retain pricing power and have less incentive to fully pass efficiency gains on to consumers. So overall, amid heightened uncertainty, the energy shock has negatively affected my outlook for both real activity and inflation. The shock has also tilted risks to real activity somewhat further to the downside and risk to inflation further to the upside. So I'm always focused on both sides of our congressional mandate, but at this point I'm particularly concerned about inflation. The supports to demand from favorable financial conditions and AI-related investment projects, in addition to the fact that the U.S. is now a significant energy producer, should limit the downside risks to economic activity. But by sustaining demand, these offsets could potentially generate continued inflationary pressures, in addition to those directly related to the energy shock. In contrast, the disinflationary impetus from recent productivity gains as firms build up new productive capacity may take some time to materialize. While underlying fundamentals remaining solid, my most likely or modal outlook continues to feature resilient demand. If the Middle East conflict is resolved relatively soon, I expect continued solid economic growth over the remainder of this year, with possibly a modest rise in the unemployment rate. But I expect little to no reduction in inflation this year, with the disinflation process gaining more traction next year. And the likelihood of other scenarios with higher and more persistent inflation, more adverse labor market conditions, or both, has increased. So given this outlook and balance of risks, I believe it will likely be important to maintain the current slightly restrictive monetary policy stance for some time. More than 5 years of above-target inflation has reduced my patience for looking through another supply shock. And it puts a spotlight on inflation expectations remaining anchored, because they're a key indicator of the Fed's credibility to restore and maintain price stability. The left panel of Figure 13 highlights that short-term inflation expectations are elevated, and also they're quite volatile. So not surprisingly, surveys find that respondents expect inflation will still be above 2% a year from now. More concerning would be evidence of longer-term inflation expectations becoming unmoored from levels consistent with 2% inflation. But as shown in the right-hand panel, most longer-term indicators do continue to be consistent with price stability. However, we can't take such anchoring for granted. This is particularly true in the current environment, with price increases already affecting fuel and perhaps soon food. Those items are top of mind for consumers and historically have been key drivers of households' near-term inflation expectations. And the association between movements in households' near-term and longer-term inflation expectations has increased somewhat recently. So it's essential for the Fed to continue demonstrating its commitment to price stability through its rate decisions and its communications. Pulling all of this together, I certainly hope for a relatively benign outcome such that policy normalization could resume later this year. However, the range of possible outcomes is wide, with risks to both the employment and the inflation sides of our mandate. Of particular concern is the possibility of a prolonged Middle East conflict that leads to more challenging policy trade-offs. And while it's not my most likely outlook, I could envision a scenario in which some policy tightening is needed to ensure that inflation returns durably to 2% in a timely way. At the moment, though, I do see the stance of monetary policy as well positioned to adjust to the evolving outlook and balance of risks. So in conclusion, I'd like to thank the Boston Economic Club for your engagement in these issues, for your time, your attention today. I look forward to exploring some additional questions with Juhi Dewan, and then also to questions from the audience. Thank you.
Thank you, President Collins, for what I thought was a very comprehensive look at the outlook, touching both on the growth side, but also some of the persistent questions around inflation. So if I may, I'd like to start the discussion by probing a little deeper into the balance of risks. First, let's start on the growth side. A large part of the discussion, you termed it well by saying resilience in the economy at a time where we are faced with this energy shock, and have really discussed the persistence being a question that could lead to downside risks if the energy shock was pronounced. I want to take it a little bit differently and ask you, if you consider the threads in much of what you said, there also seems to be a concentration of the drivers of growth in the US economy today based on a strong CapEx cycle in AI, which in turn is driving stock market returns, which are boosting the wealth effect that you talked for higher income consumers, alongside demand and power and so on, all associated with the same factor. And you contrasted that with weakness for lower income households, and let me add to that, weakness that we're seeing in construction outside of data centers, as well as some weakness in federal government spending. So is the concentration factor really something that you are concerned with, or you sort of say it's just a feature of this economic expansion?
So make sure this is... So certainly the distribution of the various factors, and there are a number of factors and they're intertwined, is certainly something that I am attentive to, pay attention to. As you mentioned, a key driver on the demand side is AI related, is related to equipment, and certainly the, we do see continued resilience on the consumption side, and the higher incomes are certainly key to that. But what I see is somewhat more widely distributed than the way that you just described it. And so if you look at the range of, the growth by industry in a variety of different contexts, it is broader. And so there is some more distribution, which is part of the reason why I have for some time been more expectant that the productivity gains that we were seeing a couple of years ago were likely to continue, and indeed they have. Again, some of that is AI, but a lot of that started well before, Chat GPT and other recent developments, and have a lot to do with a wide range of more traditional technologies. And so I think a number of the fundamental drivers around the sustained supply side, which also helps to support what is still a relatively low unemployment rate. And a relatively low unemployment rate means that, many people are working, and that is a fundamental that is also an important driver of the economic resilience. So there certainly are some factors, some of which are unusual, that are important to pay attention to, but I don't want to suggest that everything is all bundled into just a couple of factors.
Fair enough. I hope I'm not putting words in your mouth, but it seems like your near-term concern is more around inflation because of what you see as above target for a period of time. I want to ask you two questions around it, because you raised so many important points as you've kind of systematically worked your way through all the drivers. This is the fourth supply shock of this expansion. So going back to COVID, we've had the Russia-Ukraine conflict, we've had tariffs, and now we have the Strait of Hormuz. How effective can monetary policy be as a tool to combat what seems to be, I know like I said, there have been 4 shocks in 6 years, so it seems almost every second year we're having to deal with something new. But what can monetary policy do when it is really coming from the supply side?
So that's an important question, and then let me say a couple of different things about it. First of all, in terms of supply shocks, I think of the immigration changes as an additional one. I think of the productivity, the increased productivity growth also as a supply shock. So as I think about the supply shocks that are important for thinking about economic conditions and the economic trajectory, it's a long list, and I think that's notable. And so I'm very focused on supply-side developments. I think that they have become more important than I would have said a decade ago to understanding how the economy is evolving. So I think that point is very true. Are there dimensions of how supply shocks impact the economy that monetary policy is not the right tool to address? Absolutely. Having said that, as the economy evolves, our mandate will continue to be price stability and maximum employment. And so in the broader context, it's important for the Federal Reserve to keep focused on those pieces while recognizing that there are a number of developments that fiscal policy and other kinds of policies may have a more targeted role to address. And so I think recognizing that is important. I think it also is not necessarily well understood more broadly, and it's certainly one of the things I talk about very frequently when I am traveling around New England, which is the district for the Boston Fed. That people see the Fed as an organization that they think should have a more targeted impact on particular sectors, which of course we don't, except through the way that broader interest rate policy and policies more broadly have differential impacts across industries and sectors.
So there are a couple of threads there that I want to go into a little further. Let's break up the supply piece into the external side and then come back to the immigration and productivity, which is more sort of domestic issues that can be positive supply shocks versus maybe some which are coming out as negative. So there are two things that I think are interesting in the current environment that catch my eye. The first is that we are seeing the surge in AI also resulting in upward pressure in compute prices in areas related to the surge in demand. And we're also seeing what might be, and it's a question mark, but what might be the start of the end of a disinflationary force out of China, because we're seeing intermediate good prices starting to show a positive trend in prices that we have not seen for a very long time. So if this was the start of a period, and this is a big if, I'm not saying we reached the conclusion, but I'm curious to hear, if it were the case that goods prices could no longer be effectively in a disinflationary or deflationary range that persisted for 10 or 15 years prior to this, how important will be the focus for the Fed on the service price dynamics that you highlighted in particular as something that is concerning you right now?
Yeah, so a lot of parts of that question. If you go and you look at a period when the U.S. economy sustained 2% inflation over some time, it is certainly true. So, you take the period like 2001 to 2007, for example, is one example of that, if you unpack what was happening to the inflation rates of different subcategories, goods price inflation was negative over that time period, and that is widely believed as being associated in part with some of the international factors that you mentioned. At the same time, some of the other components were above 2%, and then they all averaged out to 2%. That's one way you can get to 2% inflation. It's not the only way.
That's right.
And our price stability target is the overall inflation rate, including food and energy, by the way. I mean, we often talk about core because taking out the volatile pieces gives you, an indicator of the underlying inflation, which is helpful for being forward-looking and for forecasting. But we look at the whole thing, and there are lots and lots of different combinations of inflation for the subgroups that can get you to the 2% inflation. So if it were true that goods price inflation ends up settling somewhere positive, that you could still be consistent with 2% inflation if some of the other categories settled somewhat lower. And we don't have a target for that. We don't have, something we monitor, but I think it's important to recognize, because I said a number of times this range is consistent with what we'd seen before, but it's not the only way to get to the 2%. I think it's important to highlight that. One other thing that I just want to maybe come back to is something that I said a couple of times in my remarks, and that is that the productivity gains that we've seen, including what unfolds from AI. And again, a lot of the productivity gains we've seen so far are more traditional technologies, ways of doing things, automation. One would expect that those would translate into more of a reduction in inflationary pressures than we've seen, in particular in the services. And so there is a potential as capacity, the supply side part, is built out, that you would see more of that and that would offset. You highlighted some of the the demand piece, that the strong demand will push up the prices of individual things that will then also show up in the overall inflation rate. So there are, to your point, there are lots of pieces to keep track of, but I do think that goods price inflation doesn't have to go back to where we were before for us to restore and maintain 2% inflation for the overall PCE.
So you're literally leading me to the next question because you sort of said, let's talk more about the productivity. I have to say, as an economist, I'm sure I speak for many in the audience in saying that trying to understand if we can really see a productivity breakthrough that could take the U.S. economy to just a more sustained, higher growth potential is an extremely exciting question. And to your point, it could prove to be a reason to expect the inflation rate to come in because wages adjusted for productivity, as your remarks showed, and the accompanying graphs showed, really could make a big dent. So there were two things in your comments that I want you to delve into deeper. On the one hand, you highlighted that we are seeing productivity running about 2 times what we saw in the prior cycle, which is very, very encouraging. If I think about breaking it down more granularly, we are seeing this productivity actually be quite concentrated in certain sectors of the U.S. economy where the take-up of AI, but also the new business processes that you've mentioned are really showing tangible benefits. On the other side, your charts also showed a concern that some of the same sectors were seeing the unemployment rate rise. So some of the young graduates are not getting jobs as quickly, suggesting that part of the productivity is coming as a cost-cutting exercise today rather than a revenue augmentation, which can result in new jobs in the future. So if I think about the sectors that are seeing this type of phenomenon, okay, I did a back-of-envelope calculations, but financial services, professional business services, so on and forth, they roughly account for 40% of the U.S. economy, but 20% of the jobs. So on the one side, they are driving this higher productivity, but the lower take-up areas are labor-intensive and are the ones that are seeing the immigration cutbacks that you mentioned. So at what point and how do you balance the fact that on the one side, we are seeing perhaps some pressure on white-collar jobs? Right now, we see no pressure on blue-collar jobs. As you said, hiring is very low, but potentially the supply could be a little bit more constrained.
So there are a number of dimensions to that. And again, I do want to reiterate that I think a significant part of the productivity growth we've seen so far has been broader based. In part, it was driven, I said, by necessity. As we came out of the pandemic, it was so hard to hire. A wide range of sectors, firms, small, medium-sized, and large, work to figure out how to meet demand without being able to hire. And then what a number of CEOs actually told me was that generated a list of things that they had not thought to do, but that they were working their way through. And that was true in a variety of service sectors, but pretty ubiquitous. And so the kind of efficiency mentality and mindset was a shift in approach that was pretty widespread. And so I think there's that dimension, which is distinct, in my view, from thinking about how AI is likely to impact things. And I think some of that is still playing out. I mean, as I talk to folks, they've worked a long way through the list. Many have kind of, have done the things on the list, but it takes time for that to show up. But, when demand is strong, one of the things that we have seen in our economy over the swath of history is that demand generates activities that require people and workers to do things that aren't necessarily envisioned in advance. And so, especially if you think about AI, I do think that it's easier to envision some of the tasks, and I think of AI as, either augmenting or automating And if you automate, you are probably substituting for. If you are augmenting, you're complementing tasks, not jobs. And so that's about shifting what people are doing, but it also can create new opportunities for people to do new things. And I think it's easier to see the things that might get automated than the things that might get either augmented or created. And there may be a different time frame there. So we may possibly, we may see more of the automation happen, and it may take more time for the other. So that mismatch, and we may be seeing a bit of it, but that has been a feature of some general purpose technology adoptions over time. Those two pieces of it, the automation piece and the augmentation, the new creative additions, they don't happen simultaneously necessarily, and some could get sped up this time around. We just don't really know yet. So from my perspective, all the more reason for us to, in a timely way, bring inflation back down to price stability, to give us more space, more room to be able to address over a medium term, perhaps, a potential context in which there is more mismatch as things adjust. So that's one of the ways that I think about it. And I will say, the chart that I showed was actually not across industry. It was just flagging that it's unusual to see the college age, the unemployment rate for college educated workers earlier in their careers be what is rising notably. That if you look at the longer history, typically that has been one of the lower unemployment rates. So that is unusual and it's notable, and it's something to watch carefully. Of course, anyone who's struggling to find a job, that has significant impacts. And I think we all know folks who are entering the labor market who are having difficulty finding jobs. So in aggregate, it is not showing up, that 4.3% unemployment rate, with a labor force participation rate that is still, solid. That is encouraging, but I don't want to make light of the challenges that implies for individuals, families, and communities.
Fair. A lot of green shoots and reasons for optimism, but also reasons for vigilance as we unpack some of what's transforming the economy. I'm conscious of time. I want to open it up for questions, but I'd like to address one last area, if I may, with you, as you think about your questions for President Collins. This happens to be a very important week at the Fed. Chair Powell's official standing down is, I believe, at the end of this week.
Yeah, his term as chair ends on the 15th.
On the 15th, yep. And so it's been a remarkable tenure. My personal opinion, he's done an incredible job guiding us through a number of shocks, and done it with a lot of transparency, a lot of flexibility and humility. It's been quite outstanding, I believe. With the transition always come questions about what will the change bring. So I would be remiss if I didn't ask you how you are thinking about the change in the chair position and what it could mean for the Fed as an institution, but also in particular questions and discussions that have started about perhaps modernizing the operations of the Federal Reserve.
Sure, and let me start by saying that I have really found it an honor to work with Chair Powell. I have a lot of respect for his thoughtfulness, for his integrity, and his leadership. And so I did want to start with that, and have really appreciated and learned a lot from him. I will also say that, if Kevin Warsh he has been confirmed as a governor, and if he is also confirmed as chair, then he would be the 17th chair of the Federal Reserve. And I think that's helpful to note, because over the history of the Federal Reserve, there have been a number of different chairs, and each chair brings their own approach, their own perspective. I think that's healthy and valuable. I think transitions, they always raise a lot of questions, especially in advance, but I do think that that's appropriate and helpful. And I think it's extremely valuable to have a range of views and perspectives around the Federal Reserve table. He knows, he has a lot of expertise, having been a former governor, and in many of his other professional pursuits as well. I look forward to working with him, and don't want to get out ahead of what his role may end up being, and whether there may be changes and things that he would want to put into place if he steps in as chair.
There's a lot that we could talk about on that topic, and I imagine there will be much more in the coming year. But again, I'm cognizant of time. I would like to open up and see if there are any questions that anyone would like to ask. Oh, I see many hands. I'm going to start in the front. Ellen, go ahead.
Thank you very much for your comments. You mentioned that...
Introduce yourself, if you may.
Oh, sorry. Ellen Hazen, FL Putnam. In addition to the supply-side shocks that were mentioned, you said there was also immigration and productivity, and we talked about productivity, but we didn't touch too much on immigration. I'm wondering what your thoughts are on what the immigration impact is on the supply side in the current environment, and what changes you anticipate might happen.
Sure, and thank you for asking about that. I mean, I would say there's a lot going on, and so many different factors. We saw a number of years where there was a surge in immigration that really expanded labor supply, contributed to growth, and also contributed to some of the disinflation that we saw in an earlier time period. That's something that I had spoken about, and then we've done some work on here. So the restrictions in immigration more recently are, in large part related to the decline or the decline in the growth of labor supply. And one of the unusual dimensions of the labor market that we see right now is this kind of strange balance, if you will, where it seems that job creation of just the range over the past year or so of 23,000, that's enough to be break even to absorb new people coming into the labor market. A huge amount of volatility, and understanding how that might impact different sectors differentially, because of course immigrants tend to be not equally distributed across either sector or place. So there's a lot of work that's ongoing, and I will say that since many things are happening together, unpacking exactly how much is impacted by what. But certainly the slower growth in labor demand is consistent, that understanding how that is consistent with this balance really connects directly with a much slower growth in labor supply, and that is directly related to the immigration restrictions that we've seen. So I would say more to come to understand how some of those factors are impacting the economy in a variety of different ways. So thank you for the question.
I see a hand. Jonathan and Ricardo next to each other. Maybe I will take those two together just in the interest of time. So you have to both be succinct.
Jonathan Calvert, Alvarium Analytics. President Collins, you joined your role at such an interesting time. Uncertainties around geopolitics, international and domestic, the highest inflation of our careers, and AI. I was hoping you could share with us your mental framework for making decisions under such levels of uncertainty. And I hope that was your question too.
Ricardo Adrogué, my question has to do with private credit, systemic risks posed by private credit and channels through which it could happen.
Great, thank you. So let me do private credit first. So what I would say is that anything that's growing really rapidly is something that we pay close attention to, and certainly there has been a significant growth in private credit There's some parts to that we have data on that we can follow, and then there are other parts that it's harder to have line of sight into. And so finding ways to try to explore more holistically what the growth in private credit looks like is something that's ongoing. So, again, there's some pieces of it that we have been following and that we have been exploring. And that's something that we will certainly continue to do. So it is top of mind to understand. There both are opportunities related to private credit that helps to distribute where funding is coming from for a variety of activities. But then there also are a variety of other potential risks that could relate to, for example, the linkages between private credit, banks, and other financial institutions. And so there are many things to look at and to watch, and that is something that is certainly top of mind for us, and something that we have continued conversations and analyses of. So really important question. The other one related to uncertainty, I think one of the very early speeches that I gave was all about how do you make policy under uncertainty. And, while I think there have been periods where the uncertainty seemed like it was receding to some degree, I talked quite a bit this time about how we've seen further heightening of the uncertainty. So other factors have caused it to go back up. So I would say that that uncertainty is something that we do have to recognize as we make policy decisions. And the way that I think about that is that you do the analysis, you maintain a healthy dose of humility, and you make the decisions to the best of your ability. I think all the more reason for having a very diverse set of views around the FOMC table so that people bring different assessments and different ways of weighting some of the pieces of some of the constellation of data that we have available. We look for new ways to try to see if we can maybe resolve a bit of the uncertainty. And I would say that one of the things that I mentioned briefly is a number of the key indicators that I and my team watch are very volatile right now. That's certainly true in terms of the payroll growth numbers. It's also true in terms of some of the inflation numbers, the price numbers. And so that, to me, means that looking more holistically, whether it is not putting too much weight on a particular release, but looking over time, whether it is combining one set of information with other ways of measuring things. So I think all of that becomes all the more important to try to create a holistic picture. And again, to value alternative assessments and analyses with a healthy dose of humility, and then we make the best decisions that we can and explain so that that conversation continues robustly. And at the moment, that leads me to what I call a deliberate patience. As I balance the risks and recognize that things are evolving and there are risks on both sides, and so that, from my perspective, in the current context, makes me think it's appropriate to hold where we are now while continuing to assess holistically. And again, we just got some CPI data yesterday. We got PPI data this morning. We will get the PCE, which is the inflation that we target, but that gives us quite an indicator there. But again, the data continue to evolve and we watch it closely. So thank you.
I'm conscious of time. Do we have time?
One more?
Okay, one more.
Last question.
This is President Collins' prerogative. Thank you for that. I see that hand, Jake. Yes.
Hi, Jake Schneider, President, Atlas Analytics. My question is subtle, surreptitious, and hopefully goes at the core of what we're talking about with AI productivity. And so I'd like to ask about AI productivity, or productivity the boon, whether it exists or not, related to monetary policy going forward. The late Bob Solow famously quipped that the internet was showing up everywhere in terms of productivity, except for in the economic statistics. And then later we saw it show up in the 1990s with Greenspan's famed, the Greenspan soft landing, where he raised interest rates at exactly the right time to buttress the economy as it was going into growth overdrive. Now that we're seeing economic statistics that are starting to show, as you did with the 2.5% productivity growth, showing up in the statistics, and that's potentially likely to continue, do you think that restrictive monetary policy might actually be more warranted than even you were, mentioning that the FOMC is thinking about at least keeping it steady or going into restrictive territory? If I had to say this succinctly, and I apologize, I've gone on a soliloquy, succinctly, is monetary policy at risk of being even more restrictive than we think, given the AI productivity boom that is likely unfolding? Thank you.
So I think there are a number of different, so it's interesting because I get asked a number of questions about, are you considering this that means that monetary policy is perhaps less restrictive than you think? And then are you considering that maybe makes monetary policy more consistent than you think? So I think there's a range of different factors. I will say, particularly on the AI one, I think it's very hard to tease out how much impact AI is having right now. There's a lot, just even the past couple of months, it was one of the things that people would mention in conversations towards the end of our meeting to one of the first things that's then woven into a significant part of the conversation that I'm having, regardless of the sector. So that to me is a key difference, but I don't think that it's in the aggregate data yet. I think a lot of the productivity growth that we've seen relates to some of the other factors. And, we will have to see exactly how things unfold and what they look like. But I think it's very hard to say that, at least at the moment, how much of an impact that's having and how that would offset some of the other things that would influence the impact. So, for example, our monetary policy, we target a particular interest rate, but financial conditions have to do with the whole portfolio of interest rates that people are responding to out there, and there are many factors that impact that. And so looking at overall financial conditions is much broader and has many other things that go into them than what the Fed's rate policy is. So it's clearly there, but I'm not sure that is one of the things that would be, at least for me at the moment, the most salient. Again, each of these questions has actually raised lots of things. I think that is fabulous. Thank you for the thoughtful discussion and questions. There's clearly more to talk about and more to do. And I appreciate the fact that so many of you are working on these important issues as well. And Juhi, really a pleasure.
Thank you so much, President Collins. I know I speak on behalf of everyone in this room and watching live. You have the ability and willingness to patiently share with us the nuance that goes into how you develop your thinking about the outlook for policy. And that transparency and willingness to share is especially appreciated by this crowd. So thank you very much.
Thank you. I appreciate that. Take care, everybody.
The recording has stopped.
We will now go upstairs for our last lunch of the season. We have one more event after this, which is the annual dinner next week. Thank you. Thank you.